Hey, Empowered Visionaries, welcome back to my channel. If you're new to my channel, my name is Shanvira K. Shepherd. I empower professional women to tap into their true selves and uniqueness to pursue a life aligned with their purpose. Now, in this video, I'll be going over the 10 commandments to purchasing a home. So without further ado, we'll get right into it. Now, the first commandment is thou should not change jobs, become self-employed, or quit your job. Okay. So I'm sure this should be self-explanatory for the most part. And a lot of the commandments we'll go over are will apply either before you purchase your home and up until the point of applying for your loan, and even after you've already applied for the loans. But even when it comes to your job, most lenders will look at your history as far as your job, your work, whatever it is that you do, because you can work for someone or you could be self-employed, whatever the case may be. When they approve you for a loan, is going to be based off of the information that you provided at the time you applied. So now, of course, my videos are for USDA 502 direct loan program. As I stated in my other videos, that's who I went through to purchase my first home. So most of the information I provide is going to be specifically applicable to USDA. But this information here, as far as the 10 commandments, can be utilized with any lender that you may decide to go through. Now, USDA, they normally look at about 3 years of history, but preference is given to the last 24 months. So you will want to make sure that you've at least been on your job, or you've had some type of steady income coming in for at least 24 months. Now, they may be able to, make exceptions out of that, because again, USDA makes their own rules. So, they may look at, maybe say, the last 12, like 18 months or 12 months, something in that nature. I don't know. But I do know, based off of, my own experience and information that I've read, is going to be at least 24 months. So you may want to go ahead and set yourself up for that. So even at that point, when you have been approved for the loan with USDA, that still applies. The last thing you want to do is quit your job or change jobs, because keep in mind, USDA evaluates your debt to income ratio. So that is going to determine the amount that they approve you for. So if you think like, oh, well, this new job is going to be paying me more money, and it's going to, make sense for you in the long run, that if you make more money, maybe they'll approve you for more, or that will put you in a better position to be able to pay your mortgage. It may knock off your debt to income ratio to where you may not even be eligible. So that is something that you definitely want to keep in mind. You do not want to change jobs. You definitely don't want to quit your job. That's definitely not something you will want to do. Even if you were, expected to get like some type of unemployment, and if there's like workers' comp or like something like that that's involved, that's something you will want to discuss with USDA specifically, as far as any like extenuating circumstances that are like not normal. But for the most part, it is what it is. Don't quit your job, don't change jobs, and do not become self-employed. The second commandment is thou should not buy a car, truck, or a van unless you want to live in it. Okay. This goes along the same thing with as far as your job situation. It's the debt to income ratio that they look at, right? So if you think that, oh yeah, well, great, USDA has now approved me for this loan, and I'm on the right track. I'm looking for a house, but I've been eyeing this car that I've wanted for a long time, right? And you decide that you go, trade in your Toyota Corolla for a Mercedes Benz. Yeah, you're gonna be definitely in a rude awakening, because again, that's going to end up throwing off your debt to income ratio. And we all know, in most cases, if a Toyota Corolla and you're going to get a Mercedes Benz, you're going to be paying more money. So that means you're more in debt than you were before, and that could disqualify you for a loan. Now, yes, you may say, well, what if I get into a car accident and I total my car or something happens? Again, those are extenuating circumstances that you will want to discuss with USDA. And before you actually go out and purchase a car, like, you would want to notify USDA like as soon as possible, letting them know that, hey, I got into an accident. I totaled my car. Of course, I need a vehicle. I have to get it back and forth to work. I have kids. I have a spouse, or whatever the case may be. You would want to make sure that you're discussing this information with the USDA so maybe they can guide you and like what is the best option for you. Anything can happen. You just have to be prepared for that and make sure that you are having conversations with your lender about any changes in your circumstance. The third commandment is thou shalt not use charge cards excessively or let your accounts fall behind. Now, this can really apply to like charge cards or credit cards. Okay. So just to kind of go over the difference, a charge card, which is not, it's only provided by certain issuers. Okay. You just don't get charge cards everywhere. Most of the people that I know or have seen with charge cards have been through like American Express, and they usually have businesses. So they get these charge cards and they have, it doesn't really have a set limit. And they go and they charge the card. So, and again, if they have a business, like they might have a clothing boutique or something, and they go and they need to buy inventory, and then they will buy the inventory, and then they have to pay the balance, the full balance, at the end of the billing cycle, which is every month. So it's not like a credit card where you have a preset limit, and then you run up whatever amount, whatever amount you're approved for, and then you pay this kind of monthly balance. With the charge cards, you have to pay them in full every single month. They don't have interest. And again, there's no set limits, but if you say you don't make your payment on time, then you will have some high fees, late fees, or whatever. But again, I think that in this case here, this can really apply to charge cards or credit cards, right? You do not want to, say you have a $2,000 limit on your, or say your credit card, and then you were initially approved, you only used up say $200, but then after you get your loan and you're approved, you decide to run that up to $1,800. Because one thing you have to keep in mind is that although you may be approved for your loan, USDA will continuously check your bank statements and your credit and all of that at least like every 6 months as you're going through that process. Now, hopefully you wouldn't have to stretch it out for a whole 6 months, but I'll tell you this, my home buying process lasted for 1.5 years before I finally closed on a house. So they ended up checking my credit at least about 4 times from the initial point when I applied, at least 2 more times in the midst of the process, and then at closing. So that means that during that whole time period, I was walking on eggshells. So that's something you have to keep in mind, is that anything that you're doing to prepare yourself for home ownership, and when you are approved, you're going to have to continue those same kind of acts even after you've been approved for the loan. So just make sure that you're not, again, running up your credit cards. And, if you just so happen to have to like pay something on that you're paying that thing back down immediately, so that if they do check your credit or your bank statements or whatever, that again, they're not seeing, all these, these transactions or new transactions on your reports. The fourth commandment is thou shalt not spend money that you have set aside for closing. Okay. So now, I think I stated this in one of my other videos. When I decided to apply for my loan, I had set aside my income tax money. So I was kind of like paycheck to paycheck. So it would have took me years before I would have been able to save up enough money for closing. So I decided to utilize my income tax money, and I had about maybe $8,000, but I had a little bit more than that. And that's only because I initially applied in 2021, but in 2020, we had gotten the stimulus checks, or there was like a little stipend that, were given out, because I lived in Florida at the time. So there was like these monthly payments that were deposited into our accounts, like those last like 5 or 6 months of the year. And I got the first payment, but I stopped the rest of them because I was like, I want to receive the money during income tax time. So that's what allowed me to have more money during income tax time, was because of those additional payments. So I think I had to pay off a few things, but ultimately it was about $7,000 to $8,000 that I had. But because my home buying process took like 1.5 years, some of that money started trickling away. Okay. It's like life was lifing, kids were in sports and had to buy school clothes, and then, eventually the holidays. So I really didn't have all that money. So, but again, it was a year and a half of a process. So by the next year, I got income tax again. But I said, okay, what I'm going to do, because I know I might end up spending a little bit of this money, I ended up borrowing from my 401k. So I took a withdrawal out of about $5,000 to $6,000, and I made sure I put that to the side and said, okay, I'm gonna save as much as I can of my income tax, but if I have to use some of the money, that I know I can back that up with the money that I took, the money I took out of my 401k. So you just have to, know what options you have and know your situation. But that is what I did. But of course, you want to make sure that whatever money that you do set aside or that you have available, that you're not spending it on other things, because there's going to be so many different expenses during the process, between a down payment for the house, inspection for the home, of course, maybe depending on if you have some type of closing costs, but you have to pay your first year's homeowner's insurance up front. So you just want to be prepared for any expenses. Fifth commandment is, thou shalt not omit any debts or liabilities from your application. Now, this one I'm not going to take too much time on, because like anything, you want to be as honest as possible, right? You want to make sure that you're, letting it be known as far as, everything that you have, because ultimately they're going to want to know your life story. So most of your situation should be accounted for, like, on your credit. If you have, maybe your if you're paying rent, they might be reporting that to your credit, or if you already have a mortgage, that might already be reporting. But say a car loan, your credit cards, any other loans, like personal loans that you may have, student loans, all of those should already be reported on your credit. But there might be some things that might not be showing up that you might have to tell them, like as far as if you're having to pay child support or alimony. Those are things you may have to let them know up front. And to be honest, it's only going to work out for you in the end, because again, they're going to evaluate your debt to income ratio based off of information that they have. So if you're omitting information, then you may be being approved for more than you can actually handle, or more than you would technically be approved for, and you could actually be, causing a disservice to yourself. Because, say that you do decide to max out whatever amount that they do approve you for, but you didn't account child support that you have to pay or alimony that you have to pay. And then once it's time to pay your mortgage, you're looking at, okay, they only looked at these bills, like the obvious stuff that was on my credit or whatever, but I didn't account for the child support I have to pay or my alimony. And so, now I'm kicking out way more expenses than I anticipated. So again, you want to make sure that you're providing, all the information, all the correct information, because if you don't, it's technically like committing fraud. And, you don't want to cause any issues as far as on your end, like, as far as, you not being able to pay your mortgage, or anything that may come up where you could jeopardize yourself of losing your home or whatever. So again, that is just something that you will want to definitely keep in mind. If you've gone through your home buying process, or say you have, went through or tried to apply for a loan, and, you weren't approved, and one of these situations happened to you, I want to hear about it. Like, let me know in the comments, maybe your home buying experience, or if you're actually going through the home buying process, then, make sure that you comment and let me know what that experience is. And I'll definitely try to comment, especially if you have any questions. Other than that, please make sure that you like, share, and subscribe to the channel. The sixth commandment is, thou shalt not buy any furniture or appliances on credit before closing. Now, again, as I've stated with a lot of these other ones, this is all calculated into your debt to income ratio. Whatever you do not want to put yourself in a position where you are knocking yourself out of this debt to income ratio. I remember talking to my loan specialist with my lender, and she was telling me about, someone she had worked with who did that. They had got approved for the loan. They decided they wanted to go out, I guess, just the prepare themselves, but this is before closing. So keep in mind, because you're walking on eggshells through the whole process, anything can happen to where you may not be able to get that house. So until your closing date, or at the time of closing, and you're given the keys, or the official paperwork is signed, you want to treat it as if I don't have this home and I don't know if I'm getting it. So, but this person decided to go ahead and start buying furniture and appliances and all of these things, putting stuff on credit that ended up kicking them way out of their debt to income ratio, and they ultimately ended up being disqualified for the house. So you don't want to put yourself in that position or get ahead of yourself by going out buying furniture and appliances. And I know it may be tempting. You may be excited, like, okay, this is my first house. I want to go ahead and start, looking at new cabinets and what type of appliances I want and the paint I want on the walls. And you want to do all these different things. But in all actuality, again, anything can happen during the process that may put you in a position where you may not end up getting this home. And you definitely don't want to be put in that position where you were at fault for not being approved. The seventh commandment is thou should not have any type of inquiries, originate any inquiries on your credit. Okay. So the reason being is a lot of times whenever, like usually if they've already approved you for the loan, they've already evaluated all of that. And so the rule of thumb is maybe about, say, 6 inquiries for most lenders, and they're going to also look at like, well, how recent or far back were those inquiries. And so once they've already approved you, then they've already evaluated, and that's no longer an issue. But at the point where you already have been approved, you definitely do not want to go out inquiring for more credit. Okay, because all that's going to just basically look like, okay, you're trying to take on more debt, and there is going to be red flags. It may not totally disqualify you, especially if you haven't hit the 6 inquiry mark, but it definitely will be a red flag, and it's going to definitely raise some questions as to like, okay, so what are you doing? Again, if this is a matter of, well, I got into a car accident and I totaled my car and this is what's going on, hopefully you would have already spoken to them about it, so there are no surprises. But at the same time, again, with also with being upfront with them, you just want to make sure you're not out doing frivolous things, that you're not, again, doing the furniture or appliances, or, you go out and decide you want to try to get some jewelry or something on credit. That is not the time to, go out, with your wants and the stuff that, you've been wanting to do or wanting to get, and decided, yeah, I'm going to go ahead and see if I can get this on credit. That is during your home buying process. It is not the time. So make sure that you are paying attention to your inquiries, and you're not, intentionally going out, trying to apply for credit or, any other types of loans and stuff during that process. Commandment number 8, thou should not make large deposits, right, into your accounts without first checking with your loan officer. This is really important as well. This is also tying into your whole debt to income ratio. First off, the thing is, they're going to want to know your life story. They're going to want to know all your income sources, right? So if you have a job, I don't know if the child support, I think they might give you a choice if you want to account for child support, like if you receive child support, not if you pay it. So you might not have to include that. I don't know about the alimony either. But like if they're going to want to know, like if friends or family is giving you money, maybe if you have any type of side gigs or side hustles, right, where you have like income coming in on a regular or steady basis, they're going to want to know all of that information, especially once you provide your bank statements and they see like, these deposits and stuff, even if it's small amounts, right? Even if it's, you have $15 deposited from Cash App, or $20 from Chime, or $30 coming in from Zelle. They're going to want to know, like, where is this money coming from? Who's paying you this money? What I will say is, especially when it comes to like just of those small amounts, excuse me, especially if they're irregular, then, depending on your situation, right, you could say you do something from time to time. It's not an actual side hustle or side gig. And maybe it is, but it's not like where you're receiving regular income, because there were times like very early on where I had those small deposits. But it was, hey, I might sell some stuff from time to time on Facebook Marketplace, or say if you have a garage sale, people are paying you on Cash App or Zelle for, purchasing some of your items, or you might, sell goods or something like cupcakes, cookies, or whatever at events. But this is like every now and then, every few months, that you have these, little ways that you make money, and then, they might pay you in these different ways. So you might just have to explain like, hey, this is not regular income, but these are just like some like little side gigs or things that I do from time to time where I make money. So you might have to explain that. But other than that, if this is regular income, you're going to have to let them know this. And especially, like I said, if these are large deposits, that definitely has to be accounted for. Even if it was like a one-time thing, they're going to want to know, okay, you had like $3,000 being deposited into your account. Like, what could you be doing where you're getting that kind of money? Actually, I remember, just to kind of, it ties into this a little bit, but I had a coworker who actually was going through the home buying process, and she had been told that it was okay for her to use her 401k money in order to, help with the process. And when it was time for closing, she ended up, borrowing from her 401k the money deposited into her account. So at the time of closing, they, are pulling her, credit and bank statements again. And then they see this large deposit and they're like, oh no, you are disqualified for this house. Your debt to income ratio is off now because of this large deposit. And so she couldn't get the house. And so, of course, she was livid. And so she's like, what in the world? I remember being at work, and we worked in like a call center, and she had to get off the phones and everything. Like she was just over her head. And I remember her saying that she, ended up forwarding the emails that, she had email chain between her and someone at the office, stating and telling her that it was okay for her to do that. But even with the emails, they were like, nope, we're not doing it. And so at the point when she was like trying to take it all the way up, like, no, somebody's going to have to talk to me about this. Eventually they ended up, going back, and I guess reading through the paperwork or whatever, and then determine like, okay, yeah, sorry, it does look like you can use your 401k. But just that situation could have definitely turned into something else. And say if it wasn't her 401k, what if it was, maybe a family member gave her this money? And even if they would have told her like, yeah, that's fine, that's okay, she would have been in a bad situation. So don't let that be you. Okay. But make sure you are asking questions, and make sure you do keep track of any communications or information that they're telling you, so that if anything does come up, that, you do have a chance of backing yourself up. The ninth commandment is thou shalt not change bank accounts. Now, again, this one I'm not going to spend too much time on, but this is also something that you don't want to do. Again, because of the fact that they do look at your bank statements, you don't want to change banks. That's the last thing you want to do, because it could look a little fishy, right? It could be a red flag. Like, okay, why are you changing bank accounts in the middle of this process? Now, I'm not talking about extenuating circumstances. Again, like if there was fraud committed on your account or somebody stole your identity, like some crazy stuff like that. Again, that's what you want to communicate to them about. But otherwise, if it's not outside of those situations and you're just like, oh yeah, well, I just wanted to change my bank account, I no longer want it to be with them, like they're like, okay, it's still going to create a red flag. It may not be an immediate disqualification, but they're going to definitely look deeper and like, okay, you sure you're not trying to shuffle any money around, or, trying to kind of like hide some money from us, or whatever the case may be. So it's just going to create more questions. And again, you don't want to put yourself in this position where they're like, all eyes are on you. Like they're like all into your business, and they're like, watching you like a hawk and all that. Like you don't want to put yourself in that position. So definitely just make sure, don't change bank accounts if you do not have to. The 10th commandment is thou shalt not co-sign a loan for anybody. Now, this is the thing. You shouldn't be co-signing a loan for nobody anyways, okay? I'm just being honest, all right? Now, granted, if it's a situation like you a parent and you're trying to help out your child and whatever, maybe so. It's still a gray area. To be honest, my kids are still young right now, but I don't think I would want to co-sign anything for them. I'm going to, make sure that they're set up for success, set up, as much as they need to be, so that when they get older, they can start putting things in their own name. The last thing I want them to do is mess up my credit and mess up the ability for me to do anything. So I'm just putting it out there from a mama to a mama. Okay, you really should not be co-signing for your kids, your man, cousins, sisters, friends, none of that. Okay, but that's besides the issue. So anyway, so if you decide that's the route you want to take, hey, it is what it is. But don't do this while you're trying to buy your house. Don't put yourself in a disadvantage because you're trying to help somebody else, right? You have to help yourself first before you can help somebody else. So do not, like I said, best thing to do is not try to co-sign nothing for nobody. But again, if it's one of those situations where, again, it might be a spouse or whatever, then just try not to do that during your home buying process, because that's going to, again, if you're co-signing something, that means that you are partially responsible for, whatever, like say, the money or the funds or whatever their obligation is. You are now a co-signer to that. So, if they're responsible for paying this $15,000 loan, then you're partially responsible for this $15,000 loan. And so that's a lot of money, especially most people are co-signing for things that cost a lot of money. And that's going to throw your debt to income ratio off, and that may disqualify you from purchasing your home. All right, so Empower Visionaries, if you've made it to the end of the video, I appreciate you for watching, and make sure that you like, comment, share, subscribe. Make sure you watch some of my previous videos around home ownership and the steps and processes that it will take in order for you to get there. Good luck on your process, and I'll see you in the next video.